Let's bring in Yardeni Research President Ed Yardeni. And also joining the conversation all morning long, you've got Joe Concha and you've got Mitch Rochelle, the all-star panel. And guys, it's great to have all of you here. And Ed, first, want to get your take on what you're seeing this morning versus yesterday morning. And frankly, what we're seeing, all of these concerns in the market, which is a bigger story and a bigger worry about the second half of 2021. Right. What do you say?
Well, look, there's no doubt that the economy is going to be growing in the second half of the year, but certainly there's no doubt that it's going to be growing at a slower pace than in the first half of the year. But I'm looking for 3 to 4% real GDP growth in the second half, which is awfully good. As you probably know, the Federal Reserve Bank of Atlanta has a model which is predicting 7.5% for the second quarter. So the earnings side of the equation looks really good. You're absolutely right about yesterday. The market, the stock market was a bit freaked out by what was going on in the bond market. Bond yields were coming down. Why is that troublesome? Because the perception is that the Delta virus is spreading and that might cause another downturn in the economy, a recession. And this morning, everybody got up and said, well, wait a second, if bond yields are this low, they don't look terribly attractive to invest in. Maybe we should look at stocks, which just got cheaper yesterday.
Well, let me ask you about GDP, because it is the growth story for the second half of the year that the markets are watching, the bond market's watching, the politicians are watching. So I was looking at overall for, look, we had a 2-month recession in 2020. We know that now. That's good news. But GDP, we had 6.4% in the first quarter, okay, which was almost to the record we saw back in 2019. And then we're looking at about 9% for Q2, but then those expectations come down for Q3 and Q4. What does that give you for 2021? About 6.9% GDP growth. Is that enough? Are expectations too high?
That's extraordinarily strong, though it's so extraordinary that it's not sustainable. I mean, we seem to have forgotten that the normal was about 2% real GDP growth prior to the pandemic, and many of the pessimists said that's too low, but it actually was quite sustainable for a very long period of time. We're not going to keep going at 6%. We're probably going to drop back to 2%. But I'm actually more optimistic than that. I don't think we go back. I don't think that actually is going to be normal up ahead. I think productivity is going to make a big comeback here. You mentioned all these restaurants and other employers that can't find enough workers. They're going to have to figure out ways to increase productivity. And productivity is what's going to lead to what I think is the roaring 2020s up ahead.
You think productivity will? Because in the labor market, I mean, there is concerns, obviously, about the labor shortage that we're seeing. But there's also a lot of concern about consumer prices. Like I cover, CPI, PPI for this show for Maria. Sure. And I'm not doing that because I think it's fun. I think it's crucial to market breadth. And it's what that data has been showing me, and it's been showing the market, is that consumer prices are going up. People are paying more for refrigerators, for electronics, for cars, for homes. And I think that was one of the biggest underlying currents of yesterday's sell-off.
I think you're right. I think the market is concerned that we're sort of betwixt and between. We got an economy that has been very strong, causing inflation, but now we're seeing in some of the consumer surveys that people are getting quite distressed about these higher prices, and they're starting to say, you know what, it's too expensive to buy a house, to buy a car, to buy appliances. Maybe we better hold off for a while, and so that could lead to a slowdown in the economy. So there is sort of confusion about what is going to be normal coming out of this pandemic.
Yeah, I want to bring Mitch Rochelle into this, Mitch, obviously, because that inflation story, the Fed story, all of this kind of plays into market breadth. Oh, Mitch.
I think we're missing.
Oh, yeah. Go ahead.
There we go.
There you go,
yeah,
Mitch.
I'm sorry.
Microphone on.
Yeah.
Go ahead.
Microphone on. The Russell 2000 has really sold off considerably, and I'm curious, as investors start looking for bargains, perhaps whenever you have a 1 or 2 day sell-off, they start looking for bargains. Are they going to start rotating back to the Russell 2000, which looks like it's pretty cheap right now?
Yeah, I think we all need to go to the drugstore and get a neck brace. I mean, you can really get whipsawed here quite a bit. And I think you're making a good point here. It is a market where the so-called investment styles whip around very, very rapidly. And it was from early September until March that we saw value stocks, reopening trade stocks doing well. The economy led to a rebound in small cap stocks as well. And now, just in the past few weeks, we've seen the growth stocks, particularly the big cap, the 5 big cap names that I call them the Magnificent Five, because I find it difficult to pronounce FAMG, whatever that, however you pronounce that. But the reality is they've kind of sucked all the air out of the room here in the past few weeks with their rally, all-time record high for their market cap. And I think the market is going to start broadening out again.
Mm-hmm. Yeah, and maybe it's a stock picker's market for the next 6 months as we kind of, I mean, which is not a bad thing at the end of the day. Ed Yardeni, Ed, thank you very much for being here.
Thank you.
All right.
It was a pleasure.